welcome to this edition of Closing Trades right here on ET Now with me, Aisha Faridi. And look what the markets are staging right now in the last lap of today's trade. 200 points higher for the Nifty futures. 24,650 is where we're currently at for the index. This coupled with an excellent market breadth, and I'll come to the movers in just a short while. But look at the market breadth. 163 stocks standing to the advances with just about a 50 odd standing to the reds when it comes to the futures and options universe right now in the market. And other than, of course, the oil sensitives, the likes of an Interglobe Aviation, which are holding up a good 4% right now. IT continues its uptake from last week. You've got Infosys, TCS, which are still holding out. Tata Motors PV is now playing a catch up to the rest of the auto rally, which transpired through the last fortnight or so. You've got a Shriram Finance holding up in trade. Eicher Motors is looking good. And Geo Financials, interestingly, finally awakens. For the last at least 10 days, it's been holding up almost 2% at least in the last 1 week on a daily basis and looking good. Due support from Eternal, which was a rank underperformer on Friday. It's back in the green, about 2% higher. You've got L&T, which is higher by 1.6%. Axis is looking up, and ICICI Bank, along with SBI, which are both holding up over 1% as we speak right now. And yes, great going by the broader end of the market. Look at moves on an APL Apollo, for instance, 7% higher for that stock. You've got LTM, which is higher by about 7% on the futures. Jubilant FoodWorks has jumped up nearly about 7%, and Paytm as well is a rank outperformer, holding up a solid 6.5% as we speak. This at a time when the popular trade of the gold financier seems to have taken a backseat. Both Muthoot as well as Manappuram are down, as is MCX, which is down about almost 2.5% as we speak right now. But other than that, it's been holding up well, and who better than Gautam Duggad, MD, Head of Sales Institutional Equities at Motilal Oswal Financial Services, right here in the studios to talk about where he feels the market is headed next and what his latest note has to say about the markets. Gautam, welcome to the ET Now studios. Good to have you in person here. Gautam, I was just looking at the screen and thinking in my head that what a long way we've come off from the March lows, right? Yeah. What do you think is working and what do you think is still left to be conquered?
So, Aisha, thanks for having me here. There are 2 or 3 things which are helping the markets. I think some moderation in the geopolitical hostilities, which has brought the crude down to manageable levels now. Second, I think the fatigue in the global AI trade, which had like everyone talking only about Korea and Taiwan. Wherever I have done recent global roadshows in Hong Kong, Singapore, even Europe, people were just on and on about Korea and Taiwan, and India had become like a bit of a pariah, right? So, I mean, it's good that, we are also making a comeback to an extent. But the most important thing, Aisha, which is helping at the margin is the corporate earnings. The corporate earnings season is turning out far, far better than expectations. Not just the aggregates, but even the spread of the earnings, the number of sectors, the beat to miss ratio. First time we are seeing an earnings upgrade after a very long time. And then, of course, the high frequency data points that you've seen, the auto monthly, which has come in yesterday, GST data, credit growth is almost in the 19% handle. So whatever actions the government has taken over the last 9 months, I think the reduction in income tax rate, the GST cuts, the interest rate cuts that we have seen, cumulatively, all of that is helping at the margin. And this is happening despite the monsoon still being, 15-16% deficit. And last but not the least, the last 2 years of consolidation / time correction, especially in the benchmark indices, has also made valuation a little more palatable versus where we were at 23, 24 times in September 24. Today at Nifty, we are at about 18.8 to 19.1. And EPS is holding on at about 14-15% growth. So if this earnings continues like this and expectations remain intact for September, October, I think there is more upside to be had. We have to be far more constructive on market today, purely because the underlying earnings are looking very, very strong.
So I want to pick up on your SWOT analysis one by one, and let's first talk about earnings. Because they've grown about 2% on a year-on-year basis. You were anticipating a dip of about almost 10%.
Yeah.
Would you say this is a genuine beat, or would you say this is largely an OMC-driven beat?
So I'll look at numbers. Let's for the discussion, keep OMCs out. Okay, if you keep OMCs out for the 211 companies which have declared numbers till Sunday, you take 3 out, which is 208. For them, we were expecting 13% earnings growth. The actual earnings are 17%. Similarly, for midcaps, if you exclude HPCL, the earnings is about 25% higher which is like a big number, 25% higher earnings this year, this quarter. Now you go back to small caps, about 90 small caps in our coverage of declared numbers. For them, the earnings are up close to 32%, right? Now, this is a quarter. If you look at on an annual basis, last 2 years, Nifty has done absolutely nothing. FY24 EPS was 1,000 rupees, FY26 was 1,065. So cumulatively, you got 6% earnings growth in 2 years. And market also gave you 5% return. The March 2024 Nifty market cap was 181 lakh crore. March 26 was 192 lakh crore. So whatever earnings growth you got, the equivalent market returns you got. But in this 2-year period, for example, in FY26, if you just look at the latest year, Nifty earnings were of 5%. And that was the story that India mein earnings growth nahi hai. But if you looked at Nifty 500, earnings grew 15%. My coverage universe of 380 stocks had delivered 15% earnings growth in FY26. More importantly, within that, the midcaps, and we cover a fairly large number of midcaps, almost 105 out of 150. So for those 105 midcaps, the earnings growth was 24% last year. The only sour point for last 3 years was small cap earnings, which have compounded just at about 10%. So what was 63,000 crores of earnings for small caps in our coverage for 180 companies in FY23, it ended at 83,000 crores. So 10% CAGR on a 3-year basis. Now, on that base, next 2 years, we are expecting 30% growth. So far, the first quarter, we have not seen any earnings cut. In fact, we have seen a marginal upgrade. So for my entire coverage universe, we have seen about 1.8% earnings upgrade for FY27. That sounds like music to the ears. Yeah. Second, the number of companies beating estimates and meeting expectations cumulatively are 78% of the coverage universe. So only about 22% of the earnings companies have disappointed or have missed the expectations. Number of companies where earnings have been upgraded divided by number of companies where earnings have been cut is 1.7 times. This ratio was below 1 for a very long period of time. So early signs of an earnings revival, and more importantly and hearteningly, your top line growth is in a handle of 17-18%, which is highest since December 2022. So a bit of an inflation making a comeback is also helping because last 2 years, your nominal GDP was 8.5, 8.9%. This year, we are expecting about 13% nominal GDP growth. So 14-15% earnings growth for benchmark indices looks doable for next 2 years, but the real fun is outside Nifty. As I was chatting with Sajid.
I was just going to come to that, I think the proof is in the numbers because if you look at the March recovery, or rather recovery from the March lows, it's your mid and small caps which has outperformed. Yeah. Will that play out in earnings? Or shall I say continue to play out in earnings as well? And will the Nifty earnings as well as the Nifty performance, will it continue to lag the broader markets?
I think so because look, growth is what is predominantly deciding the direction of the market and valuation and as it should rightly decide. So like I said, last year my mid-cap earnings grew 24%. If you exclude OMC, last year earnings growth for mid-cap was 20%. This year on that 20% base, again we are expecting 19% growth. So fairly solid set of numbers. For Nifty, we are expecting a 13-14% earnings growth this year, EPS of I think 12.25. Now within a 20% broad index earnings growth or my coverage universe earnings growth, you will always find 10, 15, 20 mid-cap ideas where growth is upwards of 30%. Similarly, small cap, whatever allocation increase you have seen in small cap portfolios in the last 2 months, it's happening because the earnings trajectory is changing now. On a base of 10%, 30% is doable because you have many sectors within small cap always look at bottoms up because sectoral, doesn't give you too much of insights. So you have a very low base of financials in small cap. Some of the other sectors are also having a low base. So I think the action is going to be outside of Nifty. Having said that, Nifty is looking reasonably priced, right? But, if we look at this data as a percentage of total market cap in India today, let's say if 100 is the market cap, the contribution of large cap is at a 2-decade low. The large caps are accounting for only 59 to 59.5% of total market cap of India, right? Now, if I have to play devil's advocate, I can always say that mid caps and small caps are already looking very expensive because the mid cap index is 28 times or 27 times. And small cap is close to 23, 24 times, whereas large cap, which is Nifty, about 18.5 to 19.5. So valuations is in favor of large caps, but growth is in favor of mid and small cap. And India is a growth market. If you've seen the trajectory of companies which have delivered 20, 25% earnings growth over the years, you've seen that, this might sound like a very flippant statement, but there is no cap on PE for companies that are growing upwards of 25%. And there is no floor on PE for companies which are disappointing and growing below 10%. So you have to pick your spots and then hope that whatever earnings you're building in, the companies go and deliver that.
Financials, that's the biggest pocket in the large cap space. Then there's metals as well, where there's some cyclicality. Both of those have been outperformers in this quarter. At least on the financial side, would you say that earnings will likely sustain, just given the growth which you've just spoken about? And on metals, is this kind of run rate sustainable in terms of earnings growth?
So let's take financials because that's a bigger chunk of the earnings. If I look at for this quarter, total 59 financials have already declared numbers. I was looking at the data yesterday. Out of 59 companies, 57 have either beaten or met expectations. 34 have beaten, 23 have met. There are only two companies which missed expectation. One is Bank of Baroda because of some one-off provision hit that they took.
Yes.
And the other is ICICI Lombard. Again, some adjustment they had to make.
Yes.
So financials, even at the time of preview, which we released a month back, we had called out NBFC as the sector of the quarter, right? NBFC lending. Now, NBFC lending, if I look at the 21 companies that we have in coverage, they have delivered 36% growth versus expectation of 28%. And the spread of earnings is touchwood, the best that I have seen in NBFCs in the recent times. If you look at the non-lenders, which is basically the capital market, virtually every company has beaten expectations. We cover, so far 14 have declared numbers, 12 have beaten expectations. Across the range, AMCs, brokers, wealth managers, I don't think exchanges have declared the numbers yet, but whatever numbers have come, they have been better than expectations. And now come to the bigger elephant, which is the banks. In private banks, purely looking at numbers doesn't help because there are a lot of internals which has disappointed the market, be it NIMs or in some cases credit quality and all. But if you purely look at the PAT number, out of 12 banks which have declared in the private side, almost 9 have beaten expectations.
Correct.
But our preference, even today we are underweight private sector banks. We are more bullish on PSU and more importantly, the diversified lenders. So if you look at my model portfolio, the overweight on diversified lenders is massive. So we have NBFC lenders in the form of Shriram Finance. Recently, we upgraded Bajaj Finance as Bajaj Finserv. We also like L&T Finance. We have brokers like BSE in the model portfolio. Brokers like Grow, then exchanges like BSE, AMCs like HDFC AMC. So I think the real excitement in financials over the next 3 to 5 years will be outside of banks. And that is the, I would say, template in every big cohort in India. In consumption, if you've been playing staples, you would have underperformed on a last 5, 7, 10-year basis. Correct. The real excitement was on discretionary. We bet our weight on consumer staples 0 a year and a half back, and we have not yet restored. Similarly, in technology, the excitement has been on the new age side. In healthcare, if you had looked at the traditional 5 large pharma generic companies, I was just chatting with Sajid, the top 5 large pharma companies of India, on a last 10-year basis, between FY16 to 26, the cumulative earnings CAGR is 7%, and the market cap CAGR is 8%. But a lot of wealth was created in pharma and healthcare. Where was that wealth created? Very niche segments which are growing, which is CDMOs, hospitals, diagnostics. And that is pretty much the case across all the big 5 cohorts of India, whether it is financials, tech, consumption, industrials, or healthcare. So you have to align your portfolio with the changing times today. Nifty today, unfortunately, is not representing that. I mean, if you do bottoms up on Nifty, out of the top 50 Nifty companies, 25 to 27 are just not growing. Or maybe they're growing in 5-7% band, which market doesn't like.
Correct. And what about metals, Gautam? Curious to know how the view there shapes up.
So metals, surprisingly, if whatever estimates we've had this year, this quarter obviously is far better than expectations, but in metals, things change very fast. So you have to always mark to market the underlying commodity prices. Now, if this year's expectations are delivered, it will be the first time in the last 10-15 years that metals will have 3 consecutive years of positive earnings growth. They've already delivered good growth in FY25, then FY26, and FY27 is also looking like the numbers will be upwards of 20% growth. Like within that, we obviously have our choices on the ferrous side, non-ferrous side, but as a cohort, metals earnings are looking pretty solid.
So coming back to Nifty, Gautam, from the views that you've given, private banks, IT, staples, unfortunately, these are large, matured sectors with very high weightage on the index. Would you say that the Nifty will continue to stay sort of suppressed because of the weightage of these sectors?
The way Nifty is composition, Aisha, today, that is going to be the case. You know,
It's almost like an old economy index now.
you don't have, unfortunately or fortunately, because we've not seen too much of churn in Nifty. The representation of sectors hasn't changed meaningfully. Even today, your financials at about 37, 38%, you know. And companies which are there in Nifty, obviously they've done really well. That's why they're in Nifty, right? But the kind of churn that one would see in mid-cap index or small-cap index, we've obviously not seen because they're supposed to be more stable part of the portfolio. What I would look at is, you know, typically if you look at the last 10, 15, 20-year data points, you would find that Nifty has usually compounded at nominal GDP plus minus 1-2% growth. So if your nominal GDP has grown at 10, 11%, Nifty has given you 12 to 13% return. That, I think, equation is not going to change. But within the Nifty, there is a lot of dispersion, both in terms of earnings and stock price returns. You know, case in point being last year, you know, calendar year 25, Nifty would have given you 9 or 10% return. But the best performing stock in Nifty, which was Shriram Finance, gave you 76% return. And the worst performing stock last year was Trend, which was down 35%. So plus 76 to 35 in an index which has given you 10% return. So even within Nifty, there are money-making opportunities. You just need to, you know, put your head down and see where things are changing, where the growth visibility is strong, and where you are seeing, companies which are partaking in the opportunities which are evolving. For example, consumption. You know, consumer companies, specifically if you divide it in two buckets, staples and discretionary. Staples, I think, bearing few, and they are also belonging to the food sector. But in the HPC segment, we have not really seen much of activity on the ground. Forget the market cap, forget the earnings, forget the stock price returns. If you look at their portfolios, they've barely changed. You know, 10 years back, if you see the presentation of those companies, and every company puts a, you know, slide of products in their portfolio, they've not changed much. Today, the talk is all about D2C, the distribution has changed, product has changed, the premiumization game has changed. I mean, look at discretionary. You're a company, I mean, this is factual public data, so no recommendation. And we have done this in our portfolio last year. Exact 1 year back when we published our 1Q FY26 preview, we made FMCG zero. It was underweight for 5 years. We made it zero July 2025. We removed Hindustan Lever, replaced it with Radico. Both were coincidentally around same price band, 2200, 2300. 1 year later, Radico is 4200 because the earnings growth has been upwards of 40%. And next 2 years is also looking at 30%. HUL is down 5-6% from those levels. Forget, I mean, this is just one company example. There are many examples in same sector. You know, look at liquor itself. 10 years back, Radico was, I think, 2 or 3,000 crore market cap. United Spirits, I remember, was 35,000-36,000 crore market cap. From that 2,000 crore, today Radico is 55,000 crore market cap. And United Spirits from 36 is about 1 lakh crore. So one has given you 3x return, other has given you almost 25-30 times return. So clearly market is becoming more and more discriminatory. Plus, look at the big picture view. You had 10 years of zero interest rates. So even a 5-10% earnings growth attracted 30, 40, 50, 60, 70 Ps also. Today you are looking at 10-year yields in US which are approaching almost 4.7, 4.8%. So market may not be as benign with the kind of multiples it offered you when global interest rates were zero. So today the 10% earnings growth or a 5% earnings growth may end up attracting 30, 35 P instead of 60 P. I'm just throwing a random number in the air, but the interest rate environment has changed. And the cycle has turned post-COVID. You know, till 2020, I remember, between 2010 to 2020, I think there were only 3 sectors which were growing in our coverage universe. Private banks, IT, and consumer. These 3 sectors used to account for, in 2010, I remember, 22% of our profit pool. In 2020, they became exact 45%. Right? They were growing at 10-12%, but because other sectors, commodities, global cyclicals, domestic cyclicals, they were declining. PSU banks went through the whole 5-6 years of asset quality cycle. Capital goods went nowhere. Suddenly in 2020, the cycle changed. A lot of these domestic global cyclicals and commodities made a huge comeback. So the contribution of these three sectors, which went up from 22 to 45% in 10 years, is now back at about 25-26%. And the rest of the sectors have taken the mantle on. Now, it can change.
How do you, Gautam, make your peace with the multiples within mid and small caps? Do you hunt for bottom-up stories while you can get the larger structural stories right?
Yeah, and see, there is no escaping away from bottom-up stock picking. Right. Second, you have to understand.
I mean, you can't buy a Radicode now.
See, there are two factors that decide. One is your time horizon. What is your time horizon? It's very critical in mid and small caps because you're buying at 25, 27p, not at 10 or 12p, which was the case back in 2013. You know, your mid and small cap indices had come down to 10, 12, 13p, 12 or 13p, if I remember well, during the taper tantrum episode. Today, given the dearth of growth opportunities in the large caps, people are hunting in mid and small caps. Second technical factor, last 2 years, we've seen massive FI selling. Last year's number was, I think, $19 billion. This year, first 7 months, close to $28, $29 billion. Now, FIs typically have 73 to 75% of their holding in the top 100 companies. So if they're selling, obviously, their selling will concentrate in the large cap. So private banks have not done badly on a fundamental basis. It's because they're facing extra selling pressure. Now, and on the contrary, you're getting inflows in the domestic funds. You know, so this year already we have seen, I think, we are approaching close to $60-70 billion. So, and you have only 150 midcaps. So if midcap funds are receiving inflows, that money will rotate in those 150 midcaps. So till the time this situation doesn't correct itself, either you see a moderation in FIS flows, or broad basing of the definition of midcap, you will see this valuation problem there. And then how do you deal with it? Either you extend your time horizon, or B, you become even more granular in your stock picking. So when you are paying 30, 40p to any stock in mid-cap, small cap, you have to be absolutely sure. You will still end up making mistakes. But as long as you have done your homework, as long as you have done your bottom-up stock picking, met the management, done your channel checks and whatever, then you leave it to the destiny. But okay, bottoms up is what I think will define the next 1 to 2 years, given the way earnings are positioned right now.
Very less opportunities bottom up now within mid-cap.
No, I won't say that. I would think that there are enough and more opportunities to be had across sectors. It's just that from a short-term point of view, if one is getting into mid-cap, small caps now to make a quick buck, he or she will be disappointed on a 3 to 6 months basis. But you look at the returns on a 3-year, 5-year basis, trailing also, I think, and we had done this data across indices, Nifty, Nifty 100, 150, NSE 500 and NSE 250 small cap. So beautiful data on a 3, 5, 7-year basis. You just plot the earnings for all these 5 indices and you plot their stock price return or index return. They by and large converge, barring for one time period for one index. So market has been extremely fair in rewarding companies where earnings are coming and equally brutal in punishing companies where earnings have been disappointing.
But in terms of sectors, Gautam, just to kind of wrap this conversation, you've given us great filters, right? Sub 10% growth versus 20% plus growth and the like. Are there sectors, more top-down, where this could likely be a trend which could play out maybe next 12 to 24 months, where growth will likely come in and multiples aren't as inflated or the opportunity size is very large?
So clearly, I think select pockets in auto. Right? Like we've had a preference for M&M and TVS for last 4 years now. We've removed Maruti from our model portfolio back in July 2022. We've not added it yet. Okay. Because the growth differential is massive. You go to consumer discretionary, there's sub-segments, jewelry, hotels, aviation. You can have your, and nowadays a lot of this new age companies which we've added in the portfolio, Lenskart, Misho, Grow, right? Then you go to capital markets, NBFC that we just discussed. Even in industrials, if you're sticking around with the old benchmark names, possibility of beating market is slightly low. But if you had been fortunate enough to invest in power transformers, defense at the right time, I'm not recommending them now, but if you had them in the portfolio, you would have still outperformed. Healthcare we discussed. So in every pockets, in every cohort, there are sub-segments of opportunities where growth is going to be very strong. And market will be tolerant of those high PE multiples as long as that growth keeps coming. You look at Divi's Laboratories, it's not a cheap stock by any stretch of imagination.
75 times earnings.
Yeah. But the last 2 months,
79 as we speak. Yeah.
last 3-4 months, earnings have come through. We've upgraded earnings today again by 11%. So, I mean, market is giving you a very strong message and signal. It is for the investor to,
Get
assimilate
the
that.
hint. Yeah. Okay, Gautam, great
Thank
having
you.
you in the studios.
Pleasure.
Could go on chatting. We should plan a longer chat for sure next time. But all looking good. Almost holding up that 200 point and the gain for the Nifty futures as we speak right now. We're comfortable at the index level. And once again, great going for the broader end of the market as well. On that note, we'll take a very quick break. Come right back. We'll have Mayur Patel, President and Fund Manager, Listed Equity at 361 Asset, joining in after this very quick break.
Welcome back, and we're joined in studio now by Mayur Patel, President and Fund Manager, Listed Equity at 361 Asset, joining us this afternoon. Mayur, we were just chatting just before, we got out of the commercial. You seem to be positive with regard to Indian equities now, but as is most people right now, the consensus seems to be turning now towards the positive side. Give us your sense. Is it flows that's keeping you positive? Is it earnings? What is it that's keeping you constructive?
Yeah, I'm quite bullish on the market at this point. And let me start with two things. I'm calling out two things. First, foreign inflows in our markets should pick up significantly as rupee stabilizes. And second is the corporate earnings. Corporate earnings specifically across the broader 500 universe should witness a strong earnings upgrade as we move into the second half, right? So in the near term, the big catalyst is the liquidity surge happening from the FCNRB. But after that, as West Asia conflict ends, you should see crude settling somewhere around $70, and consumer discretionary demand, CV cycle, and private capex should pick up significantly. So with Nifty at 3 times price to book, which is clearly below the 20-year median, the setup is clearly hinting towards a comprehensive rally as we move into the second half.
Where will upgrades be the most, Mayur? Because that's really the key question. If we can understand as to where earnings will surprise the best versus consensus, that could well be the answer.
So FY26 was a clear example. If you look at FY26, Nifty earnings grew by 7 to 8%. But if you look at the broader 500 companies, the earnings growth was significantly higher than the Nifty earnings growth. So the bigger story is beyond the Nifty companies. So I think while Nifty is likely to deliver 13-14% growth this year, the small and mid caps are positioned to deliver much stronger earnings growth. And even you will see more earnings upgrades, whether it's industrial, consumer discretionary, certain pockets of private capex, renewables. These are some of the areas where we are sensing earnings upgrade cycle.
In fact, renewables, we've seen the multiples compress as well. Could that be something which could really stand out? Because if earnings were a surprise on the upside and multiples have compressed, then that could be a pocket which could well be on its way.
Absolutely. If you look at the equipment suppliers or equipment manufacturers in the renewable space, the valuation multiples are reasonable, while they are on a very high growth earnings trajectory. When this Make in India is progressing well, right from module to cell manufacturing, going forward we'll be entering 100% Make in India wafer manufacturing, and there's a long earnings growth cycle, right? So with this kind of backward integration happening in the country, I think some of the leading renewable manufacturers or equipment manufacturers having good execution skills are available at good valuations. So again, no recommendations on any specific stocks, but this is on the sector. I think there is a long runway for growth.
And private sector capex, how do you suggest an investor plays that? Because there's L&T which came out with positive commentary. There's banks who have said wholesale lending has picked up in a significant fashion. Credit growth looks strong. All of that points towards a capex cycle picking up. Could this be multi-year? Because some of the valuations in some of these pockets aren't exactly comfortable, right?
Yeah, so it's early days for private capex, but we are seeing very strong signals. And if you look beyond the big pockets of capex which are happening currently from the big conglomerates, you try to plot where the future capex will come. Get into the granular details. That's where you'll see that there's a long list of corporates, mid and small, companies having more than $1 billion of capex planned. Some of the companies were really small few years back, now planning $1 billion, $2 billion capex, right? So that's across cables and wires, renewables, power T&D. There are a lot of small companies in the defense space which have got real opportunity to scale up. So again, manufacturing is India's growth story for next 10 years, right? And the Make in India is progressing well. The next phase would be design in India, right? And for that, we need to see a strong scale up in R&D. Then only we'll be able to achieve that ambitious 25% goal, right? So we are playing this theme through equipment suppliers in renewables, power T&D, electronics, data centers, and things like that. So instead of owning asset owners, we are playing through the equipment manufacturers of these things.
Got it. And what about the traditional old school sectors? IT, financials. How are you positioning yourself, or how are you recommending your clients to position themselves on those?
So in our portfolios, we are overweight on financials. We like private banks and NBFCs to play the uptick in credit growth, which has already bounced from 9% to 16, 17% levels. And with rising liquidity is likely to pick up more. With stable asset quality and margin pressures are behind. So we like financials. We like telecom as a value segment. There are a very clear earnings growth catalyst. And other old school, you mentioned, we like consumer discretionary and industrial. Industrial we already covered, but consumer discretionary witnessed a quick uptick, and then because of this West Asia conflict, we have seen a bit of a pause. But I think as we move beyond that, again, you will see pickup in CV cycle, in consumer discretionary, and some of the other pockets.
Okay. And what about IT in particular? How are you looking at this entire AI transition of sorts, which IT is going through? Are you positive at the end of this?
So currently, we are underweight on IT, and that's clearly helping. But I think the large IT services companies have to transform themselves on an urgent basis, right? So if you look at, I break the AI story into layers, you will have one layer for integration of AI, then you have a middle layer of LLM, and then you have a hardware layer. So we have a big story in the hardware layer side, which is picking up early stage, the data center story. On the top layer is where the large, leading IT services companies have to transform themselves and create a niche to benefit out of that opportunity.
Okay. And just in terms of the earnings momentum, you said that mid and small could well be the play with regard to earnings momentum, because momentum there is far stronger. Do you believe that the opportunities will come for some of these smaller companies to become larger in the traditional spaces? The banks, the NBFCs, would the smaller ones benefit disproportionately in terms of the current cycle next 2 to 3 years?
It's going to be very bottom up. So traditional segments, there are enough growth levers. Like I mentioned, manufacturing is the core growth story, and there are many traditional sectors around that. And obviously, there are many niche emerging sectors around semiconductors, around, like you mentioned, AI. There are quite a few small pockets of AI beneficiaries and things like that. Consumer tech is another area where we are seeing strong growth pickup. We have already seen a strong scale up in quick commerce as a subsegment, but there are quite a few more segments. So I would say it has to be a bottom up approach to identify scalable opportunities in the small cap space.
Okay. And last off, Mayur, anything that you're absolutely avoiding? I think IT, you're a bit cautious, but outside of that, you said you're positive on defense. What about some of the larger defense players? How are those looking?
No, so I am positive on the manufacturing as a theme. currently we have a larger allocation towards, say, renewables and power T&D and things like that. But defense is one of the beneficiaries of this theme, right? So one has to be very bottom up, and at right risk reward pick up stocks. So that's the thought process currently.
All right. Thank you so much, Mayur, for coming in and speaking to us. This has been insightful. Thank you.
Thank you.
All right. With that, we'll slip into a very short break, take a bit of a breather, come back, talk more. Lots to talk about. Even over the last half hour, 40 minutes, we've had plenty of companies come out and declare their numbers, and some good buzzers there, the likes of an Ethos and the like. We're seeing some good moves. We'll speak about that and more on the other side. Stay with us. Welcome back, and we've got Ashwin Patil, Head of Fundamental Research at LKP Securities, and someone who tracks auto as closely as probably anyone, as no one rather, on the street does. Ashwin, great having you. Let me first start off by asking you how you're looking at the numbers overall. They look like a very, very healthy set, the auto sales for July. They've been holding up very well, and this is despite the weak monsoon.
Well, hi Harsh.
Hi.
Thanks for that praise. The auto sales, as we have seen in the month of July, they have surprised everybody, I guess, because this kind of sales were not expected as such. But if you look at, closely break down the sector as such within the two-wheeler passenger vehicles, commercial vehicles, tractors, etc., then you can see, month-on-month deceleration in the numbers of most of the companies. Maybe the June base was slightly higher as compared to July. But if you look at the YOY comparison, then it's very strong growth. First of all, on across the board, I mean, two-wheelers, passenger vehicles, commercial vehicles, tractors, everywhere, the growth has been really very strong to the tune of 20-30%. Somewhere it is like 58% also in some cases. So, if you look at, company-wise, then within the passenger vehicles, we have seen the likes of Maruti, who have seen a very strong growth in the lower or the entry car segment post the implementation of GST. So after that, the growth that has been seen over there is been driven by the maybe like first time buyers. Like we heard in the call of Maruti that the first time buyers are more than 50% at this point in time. So the first time buyer in quantity has increased. Secondly, the SUV growth is very strong. The company has come out with various launches as such. Then moving on to M&M also, we have seen their new launches, doing really very good. Then if you look at, the two-wheeler segment, then we have seen, first of all, looking at Hyundai, I would say, they have reported strong numbers because last month they had seen a loss of about 13,900 units because there was a fire at one of their vendors' plant. But on that base, the company has grown. But overall, the passenger vehicle segment has really seen a fantastic growth. Then coming to two-wheelers, I would say that even Hero, who had posted subdued kind of numbers in the month of June, they have also posted very strong growth. I think the monsoon revival, which was seen in the month of July as compared to June, the deficit has really decreased to a great extent, which was close to about 30-40% across India. It is, somewhere in the lower teens, I would say. So, now the news is that even the geographies like East India, they have started getting good, rains from today itself. So that one geography was left to get a good rain. So that has also started. So I think, that deficit is going to reduce going forward. And the concern regarding El Nino, which was there for Kharif, now it is getting postponed to the Rabi season, maybe like October to December, that the onset of El Nino can be seen. So second half needs to be monitored really very well. But at this point in time, I think one should enjoy what the numbers have come in the month of July. maybe like August, September, October, we can see similar kind of growth coming with the festive season as such. But the real challenge will be there when the real festive season will be there in the month of November entirely, and probably the El Nino may see an onset and may impact the Rabi sowing. So going forward, like about 5 to 6 months, really we should watch the sector quite closely.
And with regard to the other piece is the commodity inflation, right? And how much of that is getting passed through, Ashwin? And we're getting numbers, even now as we speak. And Maruti in its con call said that they have been giving their vendors a monthly pass through with regard to the commodity inflation related costs that they are incurring, which is the vendors are incurring. Auto Ank likely to benefit over auto OEMs in an environment like this? Strong growth, that will reflect for auto Anks as well. And then on top of it, you've got some bit of cushioning on the commodity side of things?
If you see the commodity cycle, it is reaching its peak, I guess, and we have seen that on the impact on the margins of various companies that have come out with the numbers. Because Maruti came out with less than 9% kind of EBITDA margins in Q1. Even Mahindra's margins were impacted. Overall, I mean, if you see whatever companies have come out, so they are trying to push the impact to the customers as such, as they are taking price hikes. Maruti has taken about 50 bips kind of price hike in Q1. Now in August, another price hike is planned, though. Even Mahindra and Mahindra is taking price hikes, so they have to take price hikes and to pass on to the customers. But talking about the auto ancillaries, yeah, they are. I mean, they are the winners at this point in time, I would say, because they are also passing on to the OEMs the price hikes that they are seeing, and they are getting absorbed because the demand is so sharp that the OEMs, they have to agree to what the to what the auto ancillaries are saying or demanding rather. So, they are in a better position at this point in time, I would say. But on and on, I think, the companies are taking good price actions, as well as some cost efficient measures that they are taking. So, and also the product mix is expected to improve going forward. So I think, the companies are right now, they are in trouble as far as the profitability is concerned. But going forward, we need to wait and watch how the price hikes are being passed on, and how the auto ancillaries come out with their numbers going forward.
Okay. Ashwin, anything in terms of, the any nuances which have stood out for you as part of the July numbers or as part of the earnings that have come out? Anything that's standing out outside of what we've spoken about?
I would say, there is some sort of softness that we are seeing on the UV side, based on the month-on-month numbers, because even Mahindra and Mahindra has reported a slight decline, 0.8% kind of, in the month-on-month numbers. Also, if you see the two-wheelers also, I mean, everywhere the June base is slightly higher. And in most of the companies, not everywhere, I would say, but that one needs to see, because going forward, as the GST implementation had happened in September, so after September we need to see how the month on month as well as the YOY growth pans out, because both observing both of the elements or parameters will be equally important. Because month on month you may see a good a fall as well, because of higher better monsoons, maybe in July, August. So in September, October, if the El Nino sets in, then how the month on month numbers pan out need to be seen going forward.
Ashwin, of course, we'll continue to chat with you and stay updated with regard to your view on auto. But thank you so much. This was a much needed conversation.
Thank you, Harsh. Thanks, sir.
Thank you. Okay, what we'll do is also bring on board Ruchit Jain of Motilal Oswal Financial Services, joining us to give his views with regard to the markets. Ruchit, how are you looking at it? 24,500 breached, and quite convincingly, we're now floating in around 24,600. Does anything change for you in terms of levels? What are the fresh levels you're looking for this week?
Yeah, hi, very good afternoon, Harsh.
Very good
Well,
afternoon.
I think this was a very important resistance to surpass that 24,500 to 25,550 range, where previously we have seen that the markets had taken resistance twice in this entire last 2.5 months of consolidation. Now this opens up a possibility of a further up move towards 25,200, we believe, where there is a gap area. So, ascending triangle breakout has been there. And after many days, I think the index has also surpassed its 200-day EMA. I think first time after the start of the March, the entire sharp correction that we saw in the month of March, the 200 EMA has been surpassed for the first time. So 25,200, I think positionally one can expect in this leg of up move. So overall biasness seems positive. If we get any kind of intermediate declines in between also, one should look only for buying opportunities.
All right, and what about IT? That's again back 2.5% higher. I mean, on the index itself, what's the view there?
So IT sector, a couple of weeks ago, if we look at the structure, then most of the stocks were in the oversold territory, and they needed some trigger for that pullback move. So I think the results of some of the heavyweights were good, and the reaction to that results were good, and hence we have witnessed a broad-based positive move across the IT names. Now, going ahead, we believe that from next 2 to 3 months perspective, the companies where buying interest has been seen with good volumes, or either where the numbers have been good or management guidance has been good, I think they would continue to show some relative strength. But it would not be that the entire sector as a whole, mid caps, small caps, all the stocks would see a significant uptrend rally. So I think one has to be selective after this first leg of up move. So stocks where good price volume action is there, and when price up moves are supported by good volumes, I think they would continue to do well. But certain mid caps and small caps would again show some consolidation.
All right, what we'll do is, Ruchit, pause this conversation for just a bit, come back, take your picks, but need to take a bit of a breather, slip into a break, come back. Stay with us. Welcome back and thanks for being with us. FCNRB deposits have surged under the RBI's special swap window, with outstanding balances nearly doubling to $60.6 billion in under 2 months. Fresh mobilization has crossed $36.7 billion, providing strong support to forex reserves and rupee liquidity. Akanksha here with the details.
That's right. The RBI special measure to attract foreign currency continue to receive a strong response, with FCNRB deposits touching fresh highs. As of July 30, outstanding FCNRB deposits have risen to $60.55 billion, up from $32.56 billion on 5th of June, which means that banks have added nearly $28 billion in less than 2 months. Now, if we take a look at the fresh mobilization under the RBI's special swap facility, FCNRB deposits stood at $36.73 billion as of July 31st. Now, overall total mobilization under the RBI special swap facility has reached $40.82 billion, which highlights the strong response that the scheme is getting, which is being taken by central bank. Now, talking about the top contributors to this scheme, SBI continues to lead with FCNRB outstanding deposits of $13.82 billion. Among private sector banks, ICICI Bank tops the list with $6.06 billion, followed by HDFC Bank at $5.42 billion. On the other hand, if we see among foreign banks, HSBC has emerged as the leader, with FCNRB outstanding deposits jumping to $6.26 billion. If you look at the broader trend, public sector banks' FCNRB deposits have increased to $25.59 billion from $16.75 billion, while private sector banks have seen their outstanding deposits rise to $25.68 billion from $14.95 billion. And the sharpest jump has come from foreign banks, where outstanding FCNRB deposits have surged to $8.97 billion compared with just $603 million earlier. Now, remember, the FCNRB swap window will remain open till September 30, while the window for OFCBs and ECBs will continue till December 31st. So the latest number clearly shows that the RBI special measures have received a strong response from public banks, private banks, and even foreign banks for that matter, with FCNRB deposits continue to drive foreign currency inflows into India.
So much for that, Akanksha. I'm trying to now get a sense as to what this means from a banking sector standpoint. Narendra Solanki joining us as well. Of course, Ruchit Jain continues to be with us. Narendra from Anand Rathi Share and Stockbroker joins us. Narendra, just first give us a sense. I mean, broadly, what is your sense? These FCNRBs that are getting attracted, FCNRB deposits, at what rate? What is the cost of fund on this? And will banks benefit even from a cost of fund standpoint or not quite?
Yeah, I think more than from cost of funds, it's a very good liquidity boost providing to the Indian economy, and as well as it is aiding in insulating, in cushioning the rupee dollar trade. So overall, it is from a rupee perspective, it is helping in stabilizing the rupee and stemming the fall. And in last 2 months, we have seen how the rupee has broadly stabilized around these levels. So it is performing, it is helping in performing that role more right now, and also providing liquidity support to the Indian economy. Now, coming to the overall impact to the sectors, I think banking sector would be. See, if you see the overall credit growth, last month it was about 17%, and this month it is around 18.6%, and credit growth has been outpacing overall deposit growth. So from that point of view, I think it would also keep the credit growth momentum sustained to finance the growing domestic economy. So overall, net positive impact is there for the Indian economy in medium to short term.
Okay. Ruchit, let me come to you. Private sector lenders, as well as from the banking pack, anything that's standing out for you and how you're seeing the move on the Nifty Bank today?
Yes, I think overall the bank nifty is also looking positive. We have already seen a price-wise as well as time-wise corrective phase. And the index has formed a good support base around its 200 DMA, which is at 56,500, and has a room to rally towards 59,500. So the risk-reward ratio definitely seems to be favorable. If you look at the relative outperformance in this entire consolidation, which we have seen since last 1.5 months, then private sector banks like ICICI Bank suddenly takes the lead, where we have not seen the stock even going below its 20-day EMA. So the overall structure still remains positive over there. So within the banking space, ICICI Bank, I think, should do well and lead this rally in case Bank Nifty goes higher. And apart from that, NBFC is one space where we are witnessing a good price volume action. Be it stocks like Cholamandalam, Shriram Finance. Recently we have seen Manappuram Finance giving good returns. So I think Chola and Shriram both still have good room left on the higher side. So I think NBFCs and private sector banks like ICICI are set to outperform.
Okay. Your top picks for a market like this, Ruchit?
Yeah, so in this markets, I think auto is one space, another sector which has been doing well recently. And that is likely to continue because of the price volume action that we are witnessing after about 4 to 5 months of consolidation. Tata Motors is one stock that we like within the auto space. Good consolidation phase has been seen technically, an inverted head and shoulders pattern breakout has been seen today. So we expect a continuation of the uptrend over there. So around current market price of 450, short-term traders can go along with stop loss below 430 for potential targets around 485 to 490. And Siemens is another stock which technically looks quite strong, a high top, high bottom structure. Is getting continued. Prices are trading above its crucial moving averages. Last couple of trading sessions, even Friday and these 2 days volumes, if we see, these are quite, the volumes are quite better than the daily average volumes. So price up move supported by good volumes clearly indicates a good buying interest over there. So with stop loss below 3,700, we recommend to go long on Siemens as well for potential targets around 40 to 50.
Okay. All right. Ruchit, just very quickly, trying to also get a sense of any favorites within the IT pack that you're really liking, anything that's standing out for you at this point of time? You've seen a very decent rally.
So we believe that the large caps would continue to show good strength going ahead. HCLTech is one stock that we still like, even in spite of the recent up move that we have seen. I think if any kind of decline comes in the near future, then that would be bought into, because after a huge positive divergence with RSI around the recent lows, we have seen a good outperformance over there. And the potential up move for HCLTech seems to be around 1450, 1470 kind of range. So at current levels also one can go long, and if any minor dips comes, then you can take that as a buying opportunity.
Okay, Ruchit, thank you so much for joining us. We'll let you go on that note. I believe I've overshot time, but thanks so much for patiently waiting by.
Thank you.
All right, Narendra, just very quickly quizzing you with regard to IT, because this is obviously the very big theme in the market right now. How should one play it? How are you looking at this rally? And do you believe this is sustainable?
See, coming to the IT sector, if you talk about the valuation, then there was always an argument that the valuations are almost at their 10-year lows. Now, within that framework, where things are very cheap, I think you have to be stock specific. So here, our play was to look out for stocks which show some kind of a resilience and have a potential to rebound relatively far better than the others. So in this space, we preferred mid caps. More in comparison with the large cap IT space, and in mid caps or you can say tier 2 IT companies. So persistence and emphasis kind of stocks are those where we prefer these stocks in comparison with the TCS, Infosys, and SCL10.
Okay. And Narendra, is premiumization still going to be that trend? Because, you saw Ethos's numbers. Ethos's numbers look strong. Auto companies, the numbers have been quite strong as well. At least in terms of the growth momentum, it seems to be sustaining. And therefore, do you think that at the premium urban end of things, things will still continue to look good? And therefore, is that still a pocket to buy in spite of the run-up?
In auto segment right now, what we've seen is that gradually, especially post GST reforms, the market has started shifting towards the entry level products, especially in passenger vehicles segment. And likewise, hence, we have shifted our preferred pick from M&M to Maruti Suzuki, where we have seen that the entry level, or you can say below 15 lakh or 12 lakh car, has seen a robust growth in terms of volumes. So in passenger vehicles, this shift is happening as of now. So right now, we prefer Maruti in four-wheelers, and we continue to like TVS Motors in two-wheeler space.
Okay, that's the take coming in on autos and what really has stood out in terms of, the market performance. In the meantime, let's also take a look at what else has been holding out in the market. APL Apollo, of course, is seeing a very strong reaction today. It's holding up very, very smartly as we speak. Jubilant Foodworks, surprisingly, that's spurred up about 7.5%. Narendra, I'm wondering what's propelling the move in Jubilant and whether this kind of a move is sustainable or not?
Jubilant, we do not have any active coverage right now, so no comments.
That's the take right now on Jubilant Foodworks. But a lot of these buoyant mid-caps that one can spot. Look at a Godfrey Phillips as well. Solid 6.25% jump. LTM, of course, has been a very strong one. Another 6.5% of a gain coming in there as well on this particular stock price. But on the flip side, some of the exchanges, an IEX, MCX, BSE, and then, of course, the gold financiers, Manappuram Muthoot, both of them are also the laggards in trade. But, just taking a step back with 34 of the Nifty 50 companies having reported their numbers, Q1 earnings have broadly been better than what one anticipated. In fact, brokerages are saying that earnings downgrades are now moderating, with financials, materials and utilities leading the upside. Ashesha is here to walk us through the trends that one has seen so far from the earnings season.
Well, yes, we are more than halfway through the earnings season, and let's take a look at how earnings so far have been. And first up, let's start with the Nifty 50 pack and the number of companies that have reported earnings above street expectations. Now, about 34 out of 50 Nifty companies have already reported their earnings. 14 companies have managed to beat street expectations. 8 have been below street expectations. 12 in line, and 4 companies have reported a mixed bag. So that's how the Nifty 50 scorecard so far has been. Let's also
also talk about what brokerage houses are saying. Now, Citi is saying that the companies under their coverage have reported earnings better than expectations, and this is 4% ahead of their estimates. Morgan Stanley, meanwhile, says that revenue growth of about 19% is what the industry has reported, 6 percentage points ahead of their own estimates. Motilal Oswal, meanwhile, has also gone ahead and said that the numbers have largely been better than what the street was working with. So across the board, the consensus saying is that the numbers this time around so far have been better than what the street was working with. Let's also talk about the three factors that weighed heavy on the numbers in the quarter gone by. First, of course, was the input cost inflation led by West Asia crisis. Second is net interest margin pressure, especially for banking companies, and mounting losses for oil marketing companies because of the surge in crude oil prices that we have seen in the global market. These are the three factors that largely were weighing heavy on earnings season in the first quarter of FY27. Meanwhile, let's also put the spotlight on some other factors which remained at play and what brokerage houses have to say with respect to the earnings in the quarter gone by. And let's start with Citi. Now, Citi says that consumer durables, especially discretionary auto and durables, have delivered better than expected growth. Morgan Stanley says that average EBITDA growth stood at about 20%. The strongest profit growth came in for utilities, materials and financials. Industrials and utilities were leading the beat this time around, and consumer staples were some of the laggards that we saw in the quarter gone by. So this is what Morgan Stanley has to say with respect to specific sectors and the kind of performance that we saw in the quarter gone by. Meanwhile, Motilal Oswal also has come out with a report where they say that the upgrade to downgrade ratio stands at 1.6 times. In fact, they say that 70 companies have been upgraded versus 45 companies which have seen downgrades this time around, and hence the ratio stands at about 1.6 times. RIL, Bajaj Finserv, Shriram Finance, Nestle and ICICI Bank. These are the companies which saw FY27 upgrades as far as earnings estimates are concerned. And on the flip side, Interglobe Aviation, Dr. Reddy's, Tata Steel, Wipro and Maruti Suzuki. These are a couple of other stocks which have seen downgrades as far as FY27 earnings are concerned. Motilal Oswal now has financials, auto, new age, manufacturing, industrials and discretionary as their key overweights, and private sector banks, staples, energy, telecom, commodities, utilities and renewables as the key underweights in their portfolio. So this is what the brokerage houses have to say with respect to the earnings gone by. Now, several factors which will continue to remain at play going forward as well. First and the most important has to be geopolitical crisis with respect to the US-Iran war and the developments that take place there. Monsoon progress, which has been below normal so far. Cool off in input prices, which is expected to happen and will perhaps aid margins in the coming quarters. Domestic demand environment, especially rural demand if monsoon is below normal. And the AI trade, and India largely being known as an anti-AI trade, will be another factor to watch out for. So these are the 5 factors which will determine the trend for Indian equity markets going forward. But largely, the consensus has been that earnings so far have been better than what the street was working with.
Okay, that's the take right now on what the trends on earnings so far have been like. And I think just a minute to go before the new F&O closing norms kick in, Kunal, right?
It's already there.
It's already there. Okay, 3:15. Yes, it's already 3:15. How does life change now beyond 3:30?
It's the first day, but it changes a lot because the F&O market still is active. Cash market is off. There would be adjustments. We need to see how the adjustment plays out, how that closing plays out, the equilibrium, the price matching, order matching, etc. So we'll see in the next 5-7 minutes.
So heightened volatility or curbed volatility? I mean, today, of course, is day one, but yeah.
No, it will curb the volatility to a larger extent. See, I think it's just those one-off days, those, the days when there has been huge amount of buying, which impacts the VWAP prices for the markets.
That's or some earnings which comes at the fag end.
Exactly.
Yeah.
So I think that's the major part of the volatility, which is stock specific. I think those will get curbed.
Okay, that's that. But we're heading into a strong close, 189 points higher. But that's, of course, on the Nifty spot. For cash, of course, 191 points higher, 24,644 is where we're shutting shop for the day. Or I should say extended day. We don't know how we're going to shut shop, given that trading is going to be beyond 3:30 now. But other than that, Kunal, I mean, today has been one of those days when the Nifty has been equally powered as have been the broader markets. But first, let's talk about the Nifty. IT has managed to contribute today, some more push coming in from NBFCs, Interglobe Aviation, Tata Motors PV. We were talking about this earlier in the morning. And some of the private banking names as well have participated. Where do you think the leadership is now getting concentrated within the Nifty per se?
So I think IT, of course, is the top performer. It was one of the best performers in the entire month of July. I would sense at the start of August also, I think IT should continue to lead from where it left off in the month of July. There would be probably a sense that auto stocks could make a very strong comeback. I think we've seen very strong, powerful moves across few of the auto names. That's another sector which I would probably keep an eye on. You might expect some bit of a comeback of sorts towards the PSU banking names. The ones which have been huge underperformer. But for that, I think SBI has to come back into a breakout mode. Metals could be the other stock which I think could probably make a very strong comeback in this month of August, because I would sense that many of these metal stocks, Hindalco, JSW Steel, Tata Steel, etc., I think these stocks are due for a strong uptrend. They've gone through a time-wise as well as a price-wise correction consolidation. I think this sector could also be something to watch out for.
Okay, that's that on where is it that one is seeing sectoral leadership build in. Narendra, curious to know, has your view on IT changed at all?
Yeah, definitely. We were positive on the IT structurally, and we were just having a view that midcaps would be showing much better recovery, sharper recovery in comparison with their large cap peers, and the valuations definitely were very cheaper. However, the recovery would be gradual in terms of their results, and we were expecting a better recovery momentum in the second half of financial year 2027.
Okay, that's the take coming in on IT right now. But the broader market strength, that as well is fascinating today. And again, you can't really pick up any sectoral trend there, while technology, new age, cement are all, holding out well. Look at a Jubilant Food Works today. Kunal, this is a big breakout on an underperforming stock. I mean, what do you read on the charts now?
Yeah, this is a very big move for Jubilant Food, because it's not just a stock crossing back above 460, 470 today, but I think it's coming back towards almost like a 2.5 odd month high for Jubilant Food. And this was due for the stock, because after a series of a huge downtrend for the past, I think 2 or 3 years, I think if I'm not wrong, 2021 made it somewhere, Jubilant Food made a top around 750, 850 plus levels. And from there, the stock has been constantly falling. I think this could probably put a cap or the support for the stock on the longer term charts, and this could actually be a good turning point for Jubilant Food. So I would sense that this move of 5%, 6% plus, what we're seeing today for the stock price, is not just an ordinary move for Jubilant Food, but this could probably be a big signal of a turnaround for the stock.
Okay. Narendra, consumption, and I know we spoke a little bit about it on the premium side of things, but how about Jubi and QSR and the like? Is that something that you're liking? Because that's the one other trend which is at play in a big fashion. You saw those moves on Mrs. Bector's and a couple of other names also when they came out with earnings.
See, largely we are positive on the sector. Having said that, in past few months, the inflation and increase in raw material cost were main concern, which were actually impacting the margins of the company. So gradually, we expect the cost pressures to decrease, and with the price hike which we have seen in past few months, so most of the increase in cost has been passed on, and from next quarter onwards, especially in the H2 of the current financial year, we could see some improvement in their operating performance, and then we can see sustained momentum there onwards.
Okay, some of the other movers, Kunal, the likes of a Blue Dart stock has been, it's up right from the morning. But what next on this one? How are you looking at it on charts?
I would sense that the stock would probably go into a slight corrective phase first. What has happened is Blue Dart has moved from 4,800 levels 2-3 days back towards 5,600. Today, the stock opened with a big gap up. But then right from the start, the stock has actually seen a selling pressure. And from those 56, 5,800 levels, we've seen the stock ebbing off. It's almost at the day's low today so far on the intraday charts. So it looks like that maybe I think the stock would come back into filling the gap which has been created today, I would sense closer to 5,000, 5,100 could actually be a better price point to go for a contraband Blue Dart.
Okay, that's that on Blue Dart. Just, looking at where is it that the markets are settling in for the day. Bajaj Finance, of course, has been a very, very strong mover. Today as well, it's pushed up a little bit more. Gold financiers, some of the select exchange names, BSE, MCX, IEX, not such a great day for them. Muthoot Manappuram as well have turned out to be laggards today. Narendra, would you recommend buying into this weakness in either of the exchanges or the gold financiers?
See, as far as exchanges or capital market stocks are concerned, we are broadly positive on the space. However, we do not have any active recommendation on these stocks. And coming to the gold finance companies, I think most of the positives are have been priced in the markets. And right now, overall, the gold prices have also come down and stagnated. So I think the performance may not be improving from here onwards, and it would take time to consolidate here. And then maybe we could see another leg of improvement in the operating performance in this space as well.
Ather Energy was the other one which came out with numbers. 13% move on Ethos is what we're seeing. NOSIL is up 5.5 odd percent. Info Edge is up 3.5% on the back of the JobsSpeak data that they've disclosed. We've got a couple of other names. A JM Financial flat on the back of numbers. A Blue Jet Health. Well, there's some bit of disappointment on the numbers with profitability also contracting. And you've got IEX where that Supreme Court ruling has come through, which has resulted in the stock down 3.25%. So that's just some of the other names that are moving. Ethos, this 13.5% move, Kunal, looks strong. What next?
It's a very strong move. The stock doesn't go into such kind of a strong price action move. Today's volume is, I think, the highlight for Ethos because this is one of the best volumes the stock has seen over the last, I think, 1.5 years. Before on the daily time frame basis, and that looks to be a very strong contender move that the stock comes out of a major amount of underperformance. The previous highs for Ethos in 2024 were around 3,400 levels, and then the recent price correction had taken the stock towards 1,900 mark. So which means the 40% plus kind of a correction for Ethos that's now behind, and we are looking at the stock potentially going into an uptrend. The only catch with a stock like Ethos is that odd phase when the volume drops down, the activity drops down, and the stock remains listless or sideways. So I think for traders who have that kind of a knack in terms of picking up the stocks, Ethos could be a good bet, but then buying on dips could be, or rather accumulating on dips could be a better strategy for the stock.
Okay, that's that on Ather has been going very well. In fact, Narendra wanted to, get your sense in on two-wheelers. Some very strong performers from within the entire EV pack. Ather has clearly managed to, lead that entire charge. But then again, from some of the hybrid players as well, be it a TVS, Bajaj Auto, and now Hero MotoCorp as well playing catch up. Where would you find opportunity to either buy afresh or recommending adding to the existing positions?
See, as far as EV space is concerned, especially in two-wheelers, we have been seeing picking up in volumes and traction building up for the EV space. However, incumbent players like Bajaj Auto and TVS Motors are the plays which we are betting on in order to gain market share aggressively in comparison with the EV-only players. So we prefer more hybrid players like Bajaj Auto and TVS than the pure play EV players.
You have Butterfly Gandhimati's numbers also coming in. You've got revenue up 14.5 odd percent. EBITDA, you've seen a very decent jump, 30% on a YOY basis. Margins coming in at 7.1%. Profit, which was suppressed at in around the 6 crore number, has come in at 9 crore. And I'm just going to quickly also pull up for you the quarterly numbers. Well, it was an 11 crore PAT in Q4 FY26, but generally June is the softest quarter of the year. So that's broadly the kind of floor that is getting built now for the rest of FY27. We also spoke with the management of TTK Prestige earlier this morning. Narendra, is this a segment that you would bet on at all? Consumer electricals, appliances and the like?
Yeah, from medium to long-term perspective, it's a good segment to bet on. However, if you track on the recent hike in the prices of semiconductors and a lot of lack of ability because of supply chain constraints on the chips, so there has been some increase in the cost of materials. So having said that, I think 1 or 2 quarters down the line, it's a good segment to be in for medium to long-term perspective.
What about metals, Kunal? Do you go long on any of those metal names at all at a time like this?
Yeah, I think two stocks. Hindalco is something which has been looking attractive. That's a chart which I think is up the 1,000 mark, has gone through a 20% correction. So 20% correction, completion of mean reversion, we generally look out for 200 DMAs or 50 DMAs being retraced towards. Hindalco has retraced towards the 200-day moving average and seems to be bouncing off from that price point. So that's also another indicator for the stock price. And then adding to the fact, I think many of the urban metal stocks had gone through a similar kind of a correction. So I think Tata Steel went through almost a 15 to 17% correction from 220 levels to 170, 175 mark. JSW Steel has been a little bit more sideways. SAIL has gone through a major correction the last 3 months or so. So I think many of these metal stocks are going through a correction. As of now, Hindalco as well as JSW Steel are the ones which are looking attractive.
Any of the Vedanta group of stocks, Narendra, that you would look at?
Right now, we do not have any active recommendation on Vedanta Group stocks.
Okay, all right. Okay, so that's how we're shaping up. Some movers again, and in terms of meaningful movers, Kunal, Interglobe Aviation, that's the other one. Top gainer on the Nifty today, nearly 4% in terms of the move. I'll quickly pull it up. In fact, third from top. The top gainer today is Grasim now. 4.5% higher nonetheless on an Interglobe Aviation. Kunal, how's it looking like on charts? 5,400 now on Interglobe.
So this is a very strong move for Interglobe Aviation, not just because of the stock coming back towards retesting of the previous highs, but coinciding with the fact that crude oil prices are ebbed off 4.5% at the start of the day. It's actually giving confidence to the market as such that we may probably have seen a peak in terms of crude oil prices in the near term. And if we continue to see a downward trend for the crude oil prices, then I think there could be a very high likelihood that Interglobe Aviation may come back into a breakout of the previous highs. 6,000 was the previous highs for the stock in the December 2025 from where the correction started off for Interglobe Aviation. I think we are very close towards heading to that kind of a territory for the stock in the near term.
Okay, that's that on Interglobe. In fact, Kunal, let's revisit the move on Bajaj Finance along with FinServ. What next now, given that, clearly there was more legs to that big move on Friday?
So it's an exceptional move for the stock because the volumes were very strong for Bajaj Finance. The stock managed to come out with a breakout or a gap up after weeks of the stock remaining more or less sideways at the 1100, 1140 mark.